Module 1, Learning Objective 5, Basic Profitability Analysis. Now, this is a very basic introduction, and we're going to go into this in a lot more detail in a little while, in chapter 3. When managers prepare financial statements, GAAP, Generally Accepted Accounting Principles, is not a fixed formula for profits, but managers rather have some choices to make, and they have some estimates that they need to make. And you need to be aware of this because this can cause information to be somewhat misleading. And it's not that companies are being dishonest or that they're trying to mislead people, but rather they just, in certain cases, they need to make judgments. And these judgments can be neutral, but oftentimes they're biased in one direction or another. They may be overly optimistic or they may be overly conservative. And these choices affect the financial statements. So when we look at financial statements, we want to be extremely careful to understand where the judgment calls were made and whether or not we agree with those judgment calls, whether we agree with those estimates or not. If we don't agree with those estimates, then we can fool around with the numbers a little bit to get something that we might actually agree with. It makes sense here to bring up Sarbanes-Oxley. It was the case a few years ago before the Enron mess, and also WorldCom was another one at the time, where managers kind of didn't have full responsibility for their financial statements. They were actually responsible for preparing them, but oftentimes they didn't have legal responsibility for them. One of the things that Sarbanes-Oxley said is that the CEO, Chief Executive Officer, and the CFO, the Chief Financial Officer, actually have to sign off on the financial statements, saying that they reviewed them and that these accurately depict the company's performance. And there are no untrue statements of material facts. They fairly present the company's financial condition. Anything that you need to know has been disclosed. They've told the auditors everything they need to know. And if in fact, and there were the system of internal controls, that is the system that governs the interior of the company, the basic set of rules for managing the company, needs to be maintained a certain way. And if in fact it's discovered that this did not happen, then the CEO and CFO would be personally liable for losses. And so that's a very serious level of liability, and it's taken very seriously. When we're analyzing profits, the basic tool for analysis is going to be return on assets. That's considered the king of all the ratios, return on assets. Net income divided by average assets. And you would simply take, there are variations on this, we're going to go into some of them, but basically net income divided by average assets. And this can be broken into two components. One of them would be profit margin, that's net income divided by sales. And the other one is what we'd call productivity, sales divided by average assets. Now, if you've had me before, or you've had Accounting 2103, you're familiar with this. What this tells you, it's funny because I think a lot of people in business don't understand this, and it's so important. You can't imagine how important it is. There's two aspects to making profits. One is selling things for more money than they cost. And that's what profitability measures. What percentage of profit do you make on your sales? I just bought Starbucks. Starbucks profitability is fairly high because they're very expensive, right? So they make a lot of profit on each cup of coffee. Productivity, though, and this is what people don't realize, productivity can offset that. So there's a multiplicative effect between these two. In other words, your profitability, your money, your return on assets could come from profit margin on the left, or it could come from asset turnover on the right. In other words, you could sell at a very high profit margin, but not many units. And as an example of this, take a luxury jewelry brand, take Tiffany. Tiffany has very high prices, but they don't sell very much jewelry. So you go into the store, oftentimes you may be the only customer and you're going to pay a very high price. But you get a premium experience and you're willing to pay more money for that. The alternate approach is one of productivity, of selling a lot of volume. A good example of that is a supermarket. A supermarket has very low profit margin. Very, very low. They oftentimes sell things only a few pennies above cost. But they sell so much because people fill up their shopping carts with stuff that they make it up in volume. So a company can succeed with one strategy or the other. And interestingly enough, there's very few companies that are able to do both for a sustained period of time. I find it very interesting. Apple is able to do both, believe it or not. Because Apple has very high prices and they sell a huge volume of phones and also online content, obviously. But most companies are going to be strong in one area or the other. Here you can see a little analysis of this. On the left side, you see some companies that have very low turnover and very high profit margin. Here's Apple, which is an exception because it's also got pretty high turnover. Turnover would actually be much higher, but there's a complication with Apple. Oracle sells computer networking. They sell a unique product that they can charge a lot of money for. Johnson & Johnson, there you go, J&J. Intel is right up there. McDonald's is up there, believe it or not. And here's Microsoft. Microsoft sells premium products at very high prices. Here's Coke. Coke sells an expensive soft drink, and it has a very high profit margin. Over here, you can see, on the right side, you can see companies with high turnover and low profit margin. So, for example, KR is Kroger, a supermarket. TJX is TJ Maxx, very low profit margin, very high turnover. They make it up in volume. And right here is Walmart. Again, very low profit margin, but they make it up in volume. Here's Target and Home Depot. Nike's kind of in the middle, but if you see it's moved towards the right. The companies towards the center are companies that somehow manage to do both. They have high volume and they're also able to mark up their prices. The companies towards the left kind of have trouble in both of these. Now, the question is, what's the relationship between profit and stock price? So what I said previously is that we try to predict future profits, and then those future profits are assumed to be related to stock price. So what studies show is that before companies report increases in earnings, the stock prices actually go up. You would think company reports an increase in earnings. Our earnings are up 10%. The stock market jumps up. That's in fact not how it works. In fact, what happens is that if the company is going to report an increase in earnings, the stock price is going to go up. Start to go up as much as a year in advance. Because investors get advance information. Now, it's not illegal information. They get information from the company. They get quarterly reports. They get news reports, other information to know that this is going to be a good year. And so they start to buy the stock, and the stock price starts to go up. Companies that have a decrease in performance, in other words, profits are expected to be down, investors also get warning for that. And they start to sell the stock a little more, and the stock price tends to go down. So stock prices don't respond to a change in earnings after they're announced, but rather they respond to a change in earnings in advance. And that's all premised on the idea that we're talking about here, that investors anticipate future performance and they base their decisions on what they expect to happen in the future. And they're not interested in what happened in the past, only to the extent that it's going to affect the future. So this is a really interesting chart. It came out in 1968 in a key piece of research, because what it shows is that if you're able to pick a company that's going to report higher earnings, you're able to pick it in advance, then you can start to earn excess returns all year long. And that provides investors with a very heavy incentive to pick the right stock at the right time. Because if you're able to pick a stock that's going to report an increase in earnings and able to pick it in advance, then you could start to earn those extra returns and beat the dartboard. It goes the same way in the other direction. If you can sell a stock months and months before they announce a decrease in earnings, you're more likely to get a or I should say, if you hold a stock that's going to have a decrease in earnings, you're more likely to lose money than if you sell it. That's the way I should really phrase it. And financial ratios are also very closely connected with credit rating. So here you can see various different ratios and how they're connected with Moody's own ratings. And their ratings are based on the ratios in addition to other information from the company. So profits play a key role in determining the stock price, but it's not a direct role, although sometimes it's used kind of as a direct role with the PE ratio. But what it really is anticipating the future profits and then basing the stock price on your anticipation of future profits.